Is a US crypto ban incoming? That's the question on everyone's mind. The era of asking for forgiveness, not permission, is definitely over. Is this the first domino in a nationwide crypto ban? The answer is a definitive Is there going to be a ban on crypto? That's the question on everyone's mind. But honestly, it's the wrong one. It's the kind of question that keeps you glued to headlines, waiting for some dramatic announcement that might never actually happen. The real story, the one that isn't being told on the nightly news, is the massive regulatory earthquake that just happened while most people weren't even looking. While you were worried about a ban, while others were distracted, while all that fear, uncertainty, and doubt was swirling around, the game already changed. The government has been quietly passing and implementing new federal laws that are completely rewriting the rules for digital assets in America. And this silent shift is the real reason you're starting to see headlines about certain states shutting down crypto ATMs. It's all connected, just not in the way you might think. This isn't a story about a ban. This is a story about a takeover. It's about integration and about new walls and new bridges being built at a stunning speed. In this video, we're going to break down exactly what these new federal laws are, why some states are panicking about crypto kiosks, and most importantly, what the new world of American crypto regulation means for you. The old world was regulation by enforcement. To really get how huge this shift is, you have to remember what things looked like just a few years ago. The United States didn't have crypto laws, it had lawsuits. The entire industry was governed by what analysts called regulation by enforcement. This was entropy. It was chaotic, brutal, and incredibly expensive way to make policy. The SEC strategy under a previous administration was brutally simple. Instead of writing clear rules for everyone, the agency would just sue crypto companies out one by one. The outcome of these multi-year, multi-million-dollar court battles would then become the law of the land. Think about how much uncertainty that created. Major projects from Ripple and its XRP token to massive exchanges like Coinbase were dragged into legal warfare over one basic question. Is this asset a security? It was a game of regulatory roulette. A project could operate for years, build a community and a product, and then suddenly get a Wells notice from the SEC, finding itself in a fight for its own existence. For investors, it was a total nightmare. You could buy a token on a major American exchange, thinking it was totally compliant, only to wake up and discover a regulator had just declared it an illegal security overnight. The risk was enormous, and it hung over the whole market like a dark cloud. This approach didn't just create fear, it actively choked off innovation. How could any startup confidently build in the US when it had no idea which regulator to answer to, or if its token would be a commodity one day and a security the next? The lack of clarity wasn't just a bug in the system. To many, it felt like a feature designed to slowly bleed the industry dry. Capital fled overseas and projects chose to launch in places with clearer rules, even if they were in smaller markets. This was the era of ambiguity. This regulation by 1,000 cuts was the problem. It was an environment where the government wasn't handing out a rule book. It was just sending out referees to throw penalty flags after the game was already in progress. It felt like a slow, creeping ban disguised as legal paperwork. It was completely unsustainable, and it pushed Washington to a breaking point. With all this chaos at the federal level, a new, much more visible fear started to pop up: the disappearing crypto ATM. You've seen them in gas stations, convenience stores, and check cashing spots. And in some parts of the country, they're being targeted for extinction. This is where the fear of a ban starts to feel incredibly real and tangible. The epicenter of this movement right now is in Minnesota. On February 23, 2026, a bill, House File 3642, was introduced by Representative Aaron Kogel. This bill isn't about adding more warnings or lowering transaction limits. It proposes a complete total statewide ban on all virtual currency kiosks. If it passes, all licensed crypto ATMs in Minnesota would be forced to shut down. The bill has strong bipartisan support and is even being pushed by the state's own Department of Commerce. But why? Is this the first domino in a nationwide crypto ban? The answer is a hard no. To understand what Minnesota is doing, you have to ignore the crypto ban and listen to local law enforcement. Detective Lynn Lawrence of the Woodbury Public Safety Department testified, saying these machines remain one of the most effective tools that scammers are continuing to use to steal money. Sergeant Jake Lands of the St. Cloud Police described a heartbreaking case where a 78-year-old woman was scammed out of $80,000, putting her housing at risk. This isn't an anti-crypto crusade. It's a fraud prevention crusade. Scammers, often located overseas, use fear and manipulation to force vulnerable people, especially seniors, to go to Bitcoin ATMs, feed in cash, and send irreversible crypto transactions straight to their scammer's wallet. The FBI's data is staggering. Through November 2025 alone, there was over 12,000 crypto kiosk fraud complaints totaling over $333 million in losses, with adults over 60 making up the vast majority of the sum. Minnesota already tried a lighter approach. In 2024, they put in safeguards like $2,000 daily limits and mandatory fraud warnings. It wasn't enough. Scammers just adapted, telling victims to make multiple trips or even drive to neighboring states like Wisconsin to get around the limits. So from the perspective of state lawmakers who are dealing with devastated constituents that have lost their money and life savings, the kiosks themselves are the problem. And it's not just Minnesota. Vermont has extended its moratorium on new crypto ATMs. Massachusetts sued Bitcoin Depot, a major operator, for allegedly facilitating scam transactions. At least 17 states now have some form of enhanced protections, with many more looking into them. But here's the crucial part. None of these actions ban buying, selling, or holding crypto. The Minnesota bill, for example, explicitly does not affect online exchanges or mobile apps. You can still use Coinbase or Kraken. This is a targeted strike against a special physical tool for fraud. But the average person who sees a local news report that Minnesota is banning Bitcoin ATMs, that nuance gets lost. They see a ban, and the fear spirals. It perfectly shows the disconnect between what's really happening and what the public thinks is happening. Perception fueled by years of regulatory confusion. So while states are fighting a ground war against fraud at physical kiosks, a quiet revolution was taking place in Washington, D.C. This is where the story flips. This is what changes the entire conversation from ban to integration. And the first pillar of this new world is a law called the Genius Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act. This wasn't some minor adjustment. It was the first ever comprehensive federal regulatory framework for payment stablecoins in the United States. For years, stablecoins existed in a gray area. Were they commodities, securities, bank deposits? Nobody really knew. The Genius Act gave a definitive answer. So what's actually in this thing? First, it creates strict rules for any permitted payment stablecoin issuer. The biggest rule is a 1-to-1 reserve mandate. This means for every $1 of a stablecoin like USDC, the company has to hold $1 of high-quality liquid assets, like cash or short-term U.S. treasuries. No more wondering what's backing your stablecoin. The law demands full reserves. Second, it requires transparency and oversight. Issuers are now subject to regular audits and have to publicly attest to their reserves. A whole alphabet soup of regulators, including the OCC, the FDIC, and the Federal Reserve, are now involved in supervising these companies. This isn't a light touch regulation. On February 25th, 2026, the OCC released its proposed rules for implementing the act, and it's basically treating issuing stablecoins like a closely supervised banking activity. Third, and this is critical, the Genius Act explicitly defines these payment stablecoins as their own thing. It clarifies they are not to be treated as a security or a commodity, giving them their own regulatory lane. That single move ended years of debate and potential turf wars between the SEC and the CFTC over major stablecoins. Think of it like this. Before the Genius Act, holding a stablecoin was like having a private IOU from a company you hoped was good for it. After the Genius Act, holding a permitted stablecoin is like having a claim on a segregated, audited pile of cash held in a regulated financial institution. This law takes stablecoins from being a weird crypto curiosity and makes them a legitimate part of the mainstream financial system. It was the government's first major step in saying, we're not banning this, we're defining it, regulating it, and making it safe for our financial system. If you're getting some value from this breakdown and it's helping to clear up regulatory fog, do me a favor and hit the like button. It tells the YouTube algorithm that we need more clarity in this space. And if you want to stay ahead of these massive shifts, make sure to subscribe and hit the notification bell for more deep dives just like this one. let's get to the main event, unpacking the Clarity Act. If the Genius Act was the foundation, then the Clarity Act is the skyscraper they're building on top of it. The bill that the entire industry has been waiting for. It's called the Digital Asset Market Clarity Act of 2025, or simply the Clarity Act, passed by the House with strong bipartisan support on July 17, 2025. The Clarity Act tackles the biggest problem that has plagued crypto for a decade, that destructive turf war between the SEC and the CFTC. The bill's core purpose is to draw a bright line in the sand and tell everyone, once and for all, who's in charge of what. The structure it creates is revolutionary in its simplicity. First, it gives jurisdiction over digital commodities and their spot markets to the Commodity Futures Trading Commission. For years, the CFTC, which normally handles things like oil, wheat, gold futures, has argued that assets like Bitcoin and Ether are commodities. The Clarity Act makes this official. This is huge. It means that the day-to-day trading of major cryptocurrencies on exchanges would be overseen by the CFTC, the same body that oversees other major commodity markets. Second, the bill clarifies the SEC's role. The Securities and Exchange Commission keeps its authority over digital assets that actually are securities. Think of initial coin offerings or investment schemes that clearly pass the Howey test. An investment of money in a common enterprise with the expectation of profit from the efforts of others. The SEC will regulate the initial sale of these security tokens, just like it regulates the sale of new stocks and bonds. Here's a simple way to think about it. You have the FDA and the USDA. Both are government agencies that regulate things that you consume, but one is in charge of medicine, the FDA, and the other is in charge of meat, USDA. You don't want the USD approving new drugs. You don't want the FDA inspecting meatpacking plants. They have different jobs and different rulebooks. The Clarity Act is finally telling the crypto world which inspection agency, the SEC or the CFTC, is responsible for which part of the market. This clarity is a massive potential catalyst for the entire US crypto market. It gives exchanges a clear path to register and operate without the constant fear of a surprise SEC lawsuit. It also includes provisions that would grandfather certain major tokens as commodities and let new projects raise some funds without full SEC registration, all in an effort to bring innovation back to the United States of America. However, the story isn't over yet. As of early March 2026, the Clarity Act, despite passing the House, is stalled in the Senate. The main sticking point is a fierce debate between the banking industry and crypto firms over whether you should be able to earn interest on stablecoins. Banks are worried that high-yield stablecoins could pull huge deposits out of the traditional banking system. The White House is reportedly trying to broker a compromise, but for now, it's a legitimate traffic jam. The March 1st deadline passed without a final deal. Even with the delay, the direction is undeniable. Congress isn't debating whether to regulate crypto, it's negotiating the fine print of how to do it, with analysts like those at JP Morgan predicting approval by mid-2026 as a positive catalyst for markets. So what's the impact? What does this actually mean for you? So we have the Genius Act for stablecoins and the Clarity Act for markets. What does this all legal jargon actually mean? For the everyday investor, the main impact is a massive drop in regulatory risk. That fear you might have that an asset you hold like Ether could suddenly be declared an illegal security by the SEC, causing exchanges to delist it and the price to crash. That fear gets significantly smaller. By putting digital commodities under the CFTC, the Clarity Act would bring a huge sigh of relief. It means more consumer protection, clearer rules for the platforms you use, and a safer market overall. For US-based crypto exchanges like Coinbase and Kraken, this is the clarity they have been begging for. It gives them a direct path to register and be fully compliant. They finally know which regulator they answer to for which activity. This lets them plan for the long term, build new products, and compete globally with a clearer American regulatory framework behind them. Banking regulators have already signaled this new, more open stance by withdrawing some old restrictive guidance and starting to issue charters to digital asset firms. For crypto projects and developers, the new framework provides a much clearer runway for innovation. Instead of trying to navigate a minefield of legal opinions, they can build their projects from day one to comply with either the CFTC's commodity rules or the SEC security rules. That cuts down on legal costs and uncertainty, and will hopefully encourage more builders to start their projects right here in the US instead of fleeing overseas. This whole framework is a tectonic shift. It's a move away from hostility and confusion towards a defined, structured, and integrated future for digital assets in the American economy. And yes, unfortunately, there's always going to be winners and losers. Based on the new rules of the game from the Genius and Clarity Acts, here's how it looks to be shaken out. And let's start with the winners. The Clarity Act's plan to put digital commodities under the CFTC is a massive victory for both of them. It would effectively end the existential threat of being labeled a security by the SEC, giving them the legal certainty that big institutional investors have been waiting for. Second, compliant stablecoin issuers. Companies behind fully backed, audited stablecoins are huge winners. The Genius Act gives them a federal seal of approval, a license to operate, and a deep regulatory moat protecting them from shady competitors. It legitimizes their product at the highest level of the U.S. financial system. Third, U.S.-based crypto exchanges and financial institutions. They finally get the rulebook they've been asking for. This clarity lets them list assets with confidence, attract institutional money, and build the next generation of financial products without constantly looking over their shoulder. Big banks that were hesitant to get in the game now have a clearer path forward. And here are the losers: unaudited and algorithmic stablecoins. The Genius Act's strict one-to-one reserve and audit rules basically makes the business model for opaque or purely algorithmic stablecoins illegal in the United States. Their days are numbered. Second, crypto ATM operators. While the federal government is building bridges, many state governments are building walls. Targeted crackdowns on crypto kiosks because of fraud, like the proposed ban in Minnesota, put these businesses directly in the crosshairs. While some states are seeing regulated growth, the trend in many places is hostile. And finally, projects that thrived on chaos. For years, some crypto projects actually benefited from the lack of rules. They operated in the gray areas, launching tokens that walked a fine line between a utility and a security. Those days are over. The new framework forces projects to pick a lane and play by the rules. The era of asking for forgiveness, not permission, is definitely over. So let's circle all the way back to the title. Is a U.S. crypto ban incoming? After everything we've discussed, the answer is a clear, definitive no. There is zero evidence of an incoming U.S.-wide cryptocurrency ban. In fact, the exact opposite is happening. The U.S. federal government isn't building a wall to keep crypto out. It's building the roads, the bridges, and the regulatory highways to bring crypto in. It is integrating digital assets into the world's largest and most sophisticated financial system. The ban narrative is basically a ghost story, born from deep misunderstanding of what's actually going on. People see headlines about state-level actions like the ATM ban proposed in Minnesota and mistake a targeted anti-fraud measure for a broad ideological war on crypto. They're looking at the trees and completely missing the forest. The real story of 2026 is one of maturation. It's the end of the Wild West era. The chaos of regulation by enforcement is being replaced by the structured order of regulation by legislation. This new framework, anchored by the Genius Act for stablecoins and the Clarity Act for the markets, is the solution to the years of uncertainty that held the industry back. It provides the foundation for the next wave of institutional adoption, mainstream use, and real innovation. The fear of a ban was rooted in the unknown because the government's approach was so unpredictable. But now we have a clear direction. It might not be perfect, and the fights over the details will continue, but the trajectory, it is set. The United States has chosen a path not of prohibition, but of regulation and integration. The story is clear. At the federal level, Washington is moving toward clarity and integration. At the state level, the focus is on protecting consumers, which is leading to very specific targeted actions like the ATM bans to fight rampant fraud. The two things are happening at the same time, but they aren't the same story. Do you believe these new regulations are a good thing for the future of crypto in the US? Are they the key to unlocking mass adoption? Or is this just the start of a different, more sophisticated kind of government control? Let me know your honest opinion in the comments section below. Thanks for watching, stay informed, and I'll see you in the next video.